Breaking news. A financial storm is brewing for millions of savers across the UK, and it's time to wake up and take notice. HMRC is gearing up to notify up to 6 million households that they are about to face unexpected tax bills due to a little-known financial rule that has been lurking in the shadows since 2016. The Personal Savings Allowance, PSA, which was originally designed to benefit small savers by allowing them to earn a certain amount of interest tax-free, has now turned into a trap for many. As interest rates surge and tax thresholds remain frozen, this well-meaning initiative has morphed into a financial headache for countless individuals. Under the PSA, basic rate taxpayers can earn up to £1,000 in interest per year without incurring tax, while higher rate taxpayers are limited to just £500. Those who fall into the additional rate taxpayer category receive no allowance whatsoever. With savings interest rates soaring to 4% or more, it's all too easy for savers to unknowingly exceed these limits. Take, for example, a higher rate taxpayer with £12,000 in a non-ISA account earning 4.3% interest annually. They would already be over the £500 tax-free threshold, and that excess interest is now taxable at a staggering 40%. This isn't just a concern for the wealthy or high-net-worth individuals. Even average households with modest savings can find themselves caught off guard. Sally Conway, a savings expert at Shawbrook Bank, has highlighted that many people are unwittingly heading towards a tax bill, thinking their savings are working for them when they might actually be facing demands from HMRC. It's a rude awakening that's about to hit home for many. The situation is exacerbated by the fact that the tax-free interest thresholds have not budged since their inception, despite rampant inflation and significant shifts in the economy. While interest rates have skyrocketed, so too has the potential for tax exposure. HMRC is responding to this alarming trend by issuing letters to millions of households, warning them that their savings accounts have exceeded the tax-free limit. This surge in interest income isn't due to any change in saver behavior. It's a direct result of economic policy. Banks are now mandated to report the interest earned on individual savings accounts to HMRC, who then determines whether someone has surpassed their PSA and owes tax. What's particularly alarming is that many individuals are entirely unaware of their tax obligations because they don't regularly track their annual interest earnings, especially those with savings dispersed across multiple accounts. The number of accounts breaching the PSA has surged by over 5 million in just a few short years, highlighting the true extent of this financial oversight. The rules may not have changed, but the financial landscape has, and millions are now left vulnerable. Financial experts are sounding the alarm on the need for savers to utilize available tools that could shield them from this looming tax bill. Chief among these is the Individual Savings Account, ISA, which allows for tax-free interest, regardless of income level or tax bracket. Every adult in the UK can contribute up to £20,000 annually into an ISA. However, a lack of awareness or understanding means that many individuals fail to take full advantage of this allowance. In a time when interest rates are finally rewarding savers, neglecting to use an ISA could turn out to be a costly error. Furthermore, many traditional banks are offering lower interest rates compared to specialist savings providers. This means that shopping around could lead to significantly better interest income, but unless that income is protected within a tax-efficient vehicle, it remains at risk of being taxed. The frozen thresholds are quietly pushing more savers into higher tax liabilities, with more people inadvertently becoming higher-rate taxpayers due to rising incomes from inflation and annual pay increases. This shift means that even those who once believed they were safe from additional taxes are now at risk. For anyone earning just over £50,270 annually, the PSA shrinks to £500. With high interest rates, surpassing this limit is easier than ever. A few years ago, a similar savings balance would have generated minimal interest, triggering no tax. Today, that same account could yield several £100s in interest, subject to taxation, fundamentally changing the tax landscape for average savers. So, how can savers avoid the impending tax bill from HMRC? The answer is straightforward: awareness and action. Begin by reviewing all your savings accounts and calculating your total annual interest earnings. If you're nearing or exceeding your PSA, consider transferring your savings into a cash ISA to protect that interest from taxation. Diversifying your savings and exploring options beyond mainstream banks can also help you secure better interest rates and potentially advantageous ISA deals. Moreover, if you're approaching higher tax thresholds due to salary increases or investment returns, consider ways to lower your taxable income, such as pension contributions or charitable donations, which can help keep you in a lower tax bracket and preserve your PSA. It's crucial to determine whether you need to pay the tax directly via self-assessment or if HMRC will adjust your tax code. Many mistakenly assume their tax is managed automatically, but savings interest can fall outside the pay system, leading to unexpected bills. Being proactive is essential to avoid penalties or late payment charges. Utilize digital tools offered by banks or financial apps that can track your interest earnings in real time. Many apps provide insights into your tax exposure and will alert you if you're nearing your PSA limit. This entire scenario should serve as a wake-up call. The rules may not have changed, but the financial environment has, and unless you adapt, you'll be the one paying the price. Don't wait for that letter from HMRC to arrive. Take control of your financial situation today. Review your interest, explore tax-free savings options, and make sure you're not sacrificing any of your hard-earned money unnecessarily. Act now to protect your savings and stay informed.